welcome to this evening's MDCL class. Okay, we are here for the next hour to go through task 3 and task 4 of the exam. Okay, so what we'll be doing within this session is we'll be looking at the task 3, which is relating to the operating statement, looking at how we look at absorption costing versus marginal costing, and we'll be looking at the variances as well. How, when we do a control budget card, how do we actually know what we need to deal with if we deal with marginal or absorption costing? So that's what we're going to be covering in task 3. Task 4 is more to do with the statistical side of things, okay? So looking at how we cost up to certain products, how much of those products can we actually explain the reasons for the costing. So we are on task 3, which should be starting at the beginning of which page? I do apologise. Which page number is it again? We're on page 15. That's where the course starts. Okay, so I'm just going to share that page now with you. Prior to where the task starts, there is a task briefing section. Now, I would strongly advise you guys to have a look at this page, okay, purely because it does give you an indication of how long it should take you to attempt this task in your exam. So whilst you're going through revision, try and keep tasks to a maximum of 19 minutes. If you go over, it's fine, but just bearing in mind you're cutting into the time. You're cutting into time for the other tasks as well. So the more time you can bank in the easier questions, then the more you've got to play around with those that you're struggling with. Okay, so we're going to see some variances where we have to insert variances into a production card to say whether we've actually, how much we need to actually produce. Okay, taking into consideration actuals versus budget, or when we're going to flex budget as well. We're going to be recording those, okay, just to compare the difference. Okay. What we've got to think of though as well, you may get some multiple choice questions, okay, or you may get some ad hoc questions away from the workings where you've got to do a couple of tick exercises or drop down boxes. So there might be some of those questions coming through in this task, okay. So in terms of inventory valuation, okay, this here is just for an extra revision tool. Like I say, you should be knowing this by now because you should have had the course. But when your inventory levels are rising, that the profit generated using absorption costing is higher than the marginal costings, purely because when you work out that budget overhead absorption rate, using marginal costing, you are only accounting for the cost of a unit that's been produced for the units that you have sold. Okay, so the units that you've produced but not sold, that cost moves over to the next period. Okay, so you're not actually soaking up all your costs in that relevant month using absorption costing. Okay, hence, as your inventory level rises, you've got more stock left to sell, then you're going to get a more profit because you've not got as higher expenses. Whereas if you're using marginal costing, it will decrease, okay? Your profits will decrease because you're soaking up the entire overhead cost within one period. You're not shifting the units from one period to the next. You're taking all costs into consideration during that period, okay? So that just gives you a heads up of the inventory valuation. Okay, so let's have a quick look then at this first task. Okay, any questions, feel free to pop them into the chat panel. I'll answer them as we go along this evening. So task 3, it says the following budgetary control report has been provided together with the variances calculated below. Okay, so what we can see here in this top section is this is the budget that we originally set. Okay, so at the beginning of the period, this is what we wanted to use, how many hours of labour we wanted to use, how much it was going to cost us, based on the production units of 13,400. Okay, so that's how many units we wanted to produce. However, when our actual results came through, we actually produced 14,200 units, and it's told us that we've had a decrease in the usage in terms of how much kilograms that we wanted to use, irrelevant of the units produced at this moment in time. And it's told us about the hours we've worked as well and the relevant costs. Okay, so these are the two things that you need to be careful about looking at the differences. Okay. Then what we've got under here is we've got a list of the variances. So by now you should have an understanding of what variances are, especially those who have done the budgeting course, okay, because it comes up heavily in there. But in this question, it's already worked out what those variances are. The problem we have with this, though, it has not told us with those latter two whether it's an adverse or a favourable variance. So we might have to do some side calculations to be able to work what those are to prepare the operating statement. Okay, so it says here within the question, okay, the business normally prepares an operating statement under standard absorption costing principle. Okay, that's what they usually do. But the finance director has asked you to prepare one under the marginal costing principles. So what we need to look at is we need to know what the difference is when we're dealing with an operating statement when we're working with marginal. Okay. Now, if we have a look down what we've got on this list, under the variance section, we've got two variances there for material, two variances there for labour, and two variances there for overheads. Now, when we're dealing with marginal costing, we don't need to actually know all of the variances. Does anybody remember, please feel free to put the answer into the chat panel, does anybody remember what we don't need to include in our operating statement when we are dealing with marginal costing? Fantastic, fantastic. So yes, when we're dealing with marginal, putting the cost together, not the operating statement, but putting the cost together, we calculate a cost per unit based on the variables only. Okay, so when we come down to the operating statement, we're not actually interested in the overhead volume, the fixed overhead volume. That is irrelevant. We will only need to calculate the fixed overhead volume if we was doing an operating statement based on absorption costing, because it would have soaked some of the fixed costs. Yes, we still need to look at the fixed overhead expenditure because we want to compare what we thought we was going to spend for the overall expenditure cost against what we actually spend. So that will always be included in the marginal, because at the end of marginal costing, we're soaking all the fixed costs up. But in the nitty-gritty of that expenditure variance, we don't need to know about that if we're purely dealing with marginal. So in here, we can just simply put not applicable. Okay, so just remember that for your exam. If it's marginal, exclude any fixed overhead variances other than the expenditure one. Okay, so what we now need to do is we now need to go and deal with point one. Point one says place each variance into the correct column, favourable or adverse. Okay, so we can automatically put the top three in there because the top three, it's told us whether they're favourable or adverse. So I am going to put them in there, but what I'm also going to do is I'm actually, if it only gave you the figure, I am actually going to use the data in the table above to write out how they have got to that answer. So you've got an understanding, just in case it didn't tell you whether it was adverse or favourable, as it doesn't for that fourth one down for efficiency. Okay, so as it stands at the moment, will put those three figures into there. Okay, so we've got the direct price material, okay, which is a favourable of 12,425. We also have a favourable material usage of 17,750. And then we also have a direct labour rate of £45,440. So we can pop that figure in there. Okay, so we've got two left. Well, we know the direct labour one is a variable cost, so we're going to have to do a working out for this one. However, with the fixed overhead expenditure, all this one is doing is comparing the budget against the actual. So if your budget figure was 234,500 and your actual was 218, yes, let's just do those calculations to check it. 234,500 minus the 218 does give you the value of 16,500, but we need to think, is it going to be adverse or favourable? So if we wanted to spend 234, well done. Yeah, we've got answers coming through onto that chart. It's going to be a favourable variance because we've actually spent less than what we originally budgeted. Because remember, your fixed costs remain the same regardless of the level of activity when you're dealing with budgets. Okay, so we can pop that 16,500. Oh, just do that, change that colour pen, sorry. £16,500 in the favourable box here. Okay, now we need to work out what that labour efficiency rate is. Okay, so what I'm going to do is, as I've mentioned, is for those who was with me last week, we use something called the AS method to work out the variables, to work out the variances, sorry. And this is what I'm going to do now, but for both material and labour. So although we've got the results there for material, I just want to show you how they got to those answers. So if you've got a side piece of paper, feel free to copy this as we're going along. So for those who were with me, if you can remember, so first of all, we'll look at the material cost variance. Okay, so what we've got is we've got A multiplied by A, and then we've got A multiplied by S, and then we're dealing with, remember, it's SAC multiplied by S. So that's why we call it the AS method, because it's like 3 A's and 3 S's, but just remember this corner one, we have to change that to SAC. So what we need to do is we need to put the figures that we know about in the table. Okay, now because we're dealing with material cost, this side looks at the quantity and this side looks at the cost per unit relating to the quantity. So the A stands for actual, the S stands for standard, which is another word for what we budgeted to spend. So the actual material that we've used in this scenario, if we go back to the table here, so I'm going to be using figures now from this table that I've highlighted yellow and pink to complete these methods. Okay, so we've used 49,700 kilograms of material. Now, because we've got another A down here, we can just repeat that data into this box here. Okay. It's told us in the question that we actually spent £111,826. Now, if you do a reverse calculation, that comes back to £2.25 per kilogram. Okay, so that's that first part. What we're going to do now is we're going to have a look at what the S's are. So we want to try and find out what our original budget cost was. So if we bought 53,600 kilograms of material for £134 each, okay, so we just simply spread that cost. So 134 over 53,600 kilograms. That means my standard cost is £2.50. Okay, so we can simply drop the £2.50 down here as well because your S's match. So that means once you calculate the 4,9,700 by the £2.50, you've got a cost there of £124,250. Now, that's what we would call like the flex budget. Okay, so if we was to use our standard pricing for the actual purchase that we've done, that's how much it should have cost us. Okay, the next line, we need to work out what SAC is. And what SAC is the actual, sorry, yes, it was, so there's a question coming there saying, is it not labour that we're trying to work out? It is, but I'm showing you how we've got to the favourables for the material as well, just so you understand how to use this method of working out variances. Okay, so the SAC is your standard quantity for actual production. So in the question, it's telling us that we have used 53,600 kilograms of material to make 13,400 units. So we need to work out how many kilograms there is per unit. You then multiply that by the actual units of production. So that's it. That would mean if we was to actually make the 14,200 units based on what we've budgeted per unit, okay, of material, we would need to use 56,000, okay, 800 kilograms of material. So when you multiply that figure by the cost of £2.50, that will give us a cost of £142,000. Okay, so we've got some figures to work from there. Now, the next stage is to work out the difference in figures. So there'll be a method. So those who haven't seen this method before, you will see what's about to happen. So if you compare these two figures, looking at the difference between these two figures is 12,425. The difference between these two figures is 17,750. Okay, so these are the two figures that we've just put into the top two sections. So now you can see how they have got those figures. Okay, but to work out whether it's a favourable or adverse, apologies. There we go. The top variance is the cost. If you need to think of it, accountants are always interested in cash. So this variance here is our price variance, where the bottom one is our usage variance. And to find out whether it's adverse or favourable, when we're dealing with the price variance, we're interested in these two figures here. Okay, we compare these two figures. And because we've actually spent less per kilogram, then this is going to become favourable. Do the same with these two figures here. Compare these two together. We would expect to use 56,800 kilograms of material for the production of 14,200 units. However, we've only used 49,700 kilograms of material, sorry. So we've used less than expected, which is also another favourable variance. So the overall cost variance, so the overall materials cost variance, is where you add the two variances up together. So adding the 12 and the 17,000, that gives us a total of 30,125 favourable, and that is the overall material cost variance. Okay. How would that go to the total direct material? Okay, I think has that answered your question, Abby? So that's your total direct material cost there. Yeah, fantastic. Okay, so you just add those two variances up. Okay, so we're going to do the same now for the labour one. So by practicing this, you can only use this method when you're dealing with variable variances. So we'll go back to do labour this time. So header this time is your labour cost variance. Using the same method, A multiplied by A, then you've got A multiplied by S, and you've got S multiplied by S, but remember, change this one to SAC. Okay, so let's go through. Let's have a quick look. Is that my calculations? 30175. Have I just typed that wrong? I do apologise. It is 30175, not 30125. It does say 7 on my notes. I think my circle's gone over the 7 to take off the bottom. So yeah, apologies for that, and thank you. Thank you for pointing that out. 30175. Okay, so going back here, looking at the actual labour we have used in production this time. So in the question, the actual labour that it's saying we've used is 45,444 hours. So we can simply drop that down in here. Okay, we've got a total cost of our labour cost, which is 408,960. So reverse that calculation to get the hourly rate of £9. Okay, let's have a look at what our standard cost is. Okay, so our standard cost therefore is the cost of what we're doing that in red, sorry, 321,600. Divide that by the hours of 40200. That gives us a budgeted cost of £8 per hour. Okay, so if we multiply that by the actual hours, we've got a flex cost of 363,520. Okay, well done. Okay, there are other ways that you can calculate, obviously, variances out, which are given in certain training providers' books. However, this is the method that I use and I teach, and me personally, obviously, I'm going to be biased. I do think it's a quicker way of, working things out. But again, it's entirely up to you which methods that you do get used to. Okay, so in terms of the cost, then we can just simply drop that down to £8, and we've got an answer in there saying 4260, which is correct. Well done. So let's have a quick look how we work that out. And yes, it's variances, you can struggle with those. So again, if you've not, you've just said there that you've not seen it before, so hopefully I've given you something that you can work through. So that's SAC then. We've got budgeted then, we've got 40,200 hours, which we're going to divide by the units of production of 13,400 to get how many hours it is per unit. We're then going to multiply that then by the actual of 14,200, and as Dahlia did state the correct answer in the chat panel, it's 42,600 hours. So if we were to make if our budget did say 14,200 hours based on how many hours that we need for that unit, we should expect to use that amount. So we're just going to multiply that by 8, and that's going to give us a total figure of 340,800. Okay, so compare the differences. So we've got £45,440 there. We've got 22,720 here. And then going even further to get your overall labour cost variance, well, we can't do that at the moment, okay? So, sorry, the calculation for SAC, is you've got the 40,200 hours, so that's your budgeted hours, okay, that you've used, divided by your budgeted units, multiplied by your actual units, and it's 42,600 hours, okay. So let's have a look at the difference. We want to compare the rate first. We've spent more than what we wanted to say, so the labour rate therefore is adverse, okay, which we've already established that in the question, but this is the one that we needed to work out whether it was adverse or favourable, okay. So I would say, Dahlia, again, you've hit the nail on the head. Yes, it is an adverse because we are comparing the figure that we've calculated against the actual use, okay, the usage. So we want to know how efficient our staff have been. So we are saying that if we're to make 14,200 units, we should expect our staff to work 42,600 hours, but they haven't. They've actually worked more to make those 14,200 units. So we've ended up spending more as a business. So the staff have not been as efficient as we wanted them to be. So this is the efficiency variance. Okay, and again, that becomes adverse. Now we can work out the cost because we've got two adverses there. And we just add both the figures up. Sorry, my keyboard keeps appearing. So that therefore becomes 68,160. Okay, so your total labour cost is an overall adverse variance. Okay, if you had a favourable against adverse, okay, you just offset them against each other. So if you've got a higher favourable and a lower adverse, your overall will become a favourable and vice versa. Okay, so it did seem a little bit long-winded, but the reason why I did that is just so I can explain how they've got to the variances in the question. Okay, so now we're aware that this is an adverse variance, we can go and pop that figure under the adverse column. So that's 22,000, when my pen works, £22,720. Okay, so we've dealt with task one. Okay, so now what we're going to do is we now need to complete the shaded boxes. Okay, so the first thing that we're going to look at then is the top section, the budgeted variable cost for actual production. Okay, so the variable cost for actual production, if we go back up to the table, we have got two figures here. They're your budgeted variable costs. So all you're going to do is you're going to add those two figures up. Okay, so I'm just going to do a side workings here. So you've got 321,600, add together the 3,400. Okay, once you've added those two variable costs together, okay, we then divide that by the budgeted units of 13400, and then you multiply it by the actual production that you've used. So the answer that will sit in that first box is 482,800. Okay, so Sarah, I'll come back to your question when I get down to that line, just to reiterate. Okay, not to worry. So 482,800. So what's the budgeted fixed cost? You just take that direct from the table. So that's 234,500, which gives us a total budgeted for actual production is 717,300. Okay, doke. So that is what our actual flex budget would be. Okay. So just to reiterate, when you look at what it says in here, what is the budgeted variable cost for actual production? So all we want to do is just another example, just to make it easy to understand. If I had another column here that said flexed budget, what I'm going to do is I'm going to turn my data into figures. So the flex would still be 14,200 units because it's got to meet the actuals. Okay. When we deal with material, okay, we've worked out the cost per unit. Okay, we worked out these two figures using SAC, didn't we? Okay, the standard cost for actual quantity. Okay, SAC, there we go. So we can take the cost that we calculated down here for your variables. So we can see you've got your variable figures here. So these are your flex budget figures in terms of cost. So if we just add those figures into the box, so we've got for material 142,000, and then we have got 340,800. Okay, so you've got your budget figure there. And then your fixed overheads should be the same to match your budget. So that'll be 2, 3, 4, 500. So you can work it out as a table like that if you want to. Okay. So just to incorporate, what we are doing in this question is we are looking at an operating statement. When you deal with the cost per unit, okay, cost per unit, you only look at the variable costs, because once you've done the full production, that is when you add the total fixed cost onto it. Okay, if you was dealing with absorption costing and not marginal costing, then that is where you'd have to look at the overhead absorption rate as well. So because we are looking at an operating statement, we're now looking at the full production. Okay, so this is why we do a flex budget, to say what would the costs be if I was to make the actual units. So if we have a look at this flex column that I've just calculated, if I was just to use marginal costing, I am only, I've just done it on a blue pen there, do apologise. If I'm looking at marginal costing, I only want to know what my total variable cost would be, which are those two figures added together, okay, which is 482,800, which match this figure here that we've just calculated. But that can also, you know, all this sum here does is just stating what we've done in this flex column here. Okay. Once we have worked out what the variable costs are, because we're dealing with marginal costing, we need to put the whole fixed cost to the operating budget. Okay. So that's why we've put 324,500. So that is what our new total budget for actual production would be. So we then go down and deal with the variances as we've dealt with. Okay, now the fixed overhead volume, just to reiterate, because I know some learners came in later. This is only relevant when you are dealing with absorption costing. Now, because this question has said the finance director has asked you to do an operating cost statement under marginal, you're going to include that. The only one that we need to compare with marginal is the actual versus budget in terms of cost. So you can totally ignore the overhead absorption rates, where you've got to do all your variances for your other fixed variances. Okay. Right, so once you've done, put your figures in there, what we're then going to do is we're going to calculate the total variances. Okay, so you just total each of the sides. So that becomes 46,675. This becomes £68,160. So we can clearly see that adverse is higher than the favourable. So this here, the total must be adverse. So you're going to take off favourable from adverse, offset them against each other. So we have a total variance of 21485. Okay. So this is where we've got to look at the figures that we've got. If this was our budget figure, read your data, and this is what the actual is, if we've been told that we have got a variance, which is an adverse, does that mean that our actual cost is higher or lower than our budget cost? You want to pop something in chat? Adverse is a negative impact on the business, okay? So if it's adverse, you have spent more money, which means your actual production is higher than your budget. So well done for those who put higher. So that becomes 738,785. Okay. Great stuff. So yes, quite rightly, just one thing that I was going to point out afterwards, once you have calculated this to know that you've got it correct, this figure here should match this figure here, okay, which it does. Yes. So well done, Sarah, for stating that, which you've took the words right out of my mouth just before I was about to move on to the next task. That's how you can double check you've done your calculations because it's kind of we're reconciling what our actual costs are against to the flexed. Okay. So that's the first part of task 3. What we're now going to do is we're going to now look at the last question. Okay. So if we have a quick read of this question, it says another business has a budget overhead absorption rate of £45 per unit and a budget production of 30,000 units. The actual production was 39,000 units and the actual overhead was 1,410,700. Okay, so we've got a couple of figures here that we can play around with. Okay, dokes. So, first thing that we need to do, let me have a quick look. Right, so a question is coming into the chat panel saying, would we only need to work out labour efficiency, okay, in the exam? No. You might get given any of these in the exam to work out. Hence the reason I went through how to get the answers of the variances, okay, by using this method here, okay? So it might not be labour efficiency that you've got to work out. You might have to work out material usage. You might have to work out labour. You might have to work out them all. It might even tell you that, you know, we haven't got a figure for this. Can you work that figure out? So by you being, you using your knowledge of how to work variances out, this is why this table is probably a good tool for you to use, then that would be sufficient enough. It says, but for this question, yes, so quite rightly, yeah. So in this question here, yes, you would only need to work out what this efficiency is. So if you know the efficiency is the bottom half, just do, this section of the variance if you wanted to, okay? But the reason why I did it in full is just so everybody had an understanding of how the question got to each of the variances. So yeah, if you've got really good knowledge of how to do it, feel free just to use that bottom line to work out what it was. Okay, so right. So moving on to this last part of the question, okay, we've got some figures to think about. So when we deal with working out whether we've over or under absorbed, okay, we need to flex our budget again. So if we have got an overhead absorption rate of £45, okay, instead of multiplying it by the budget production, we're going to multiply it by the actual units we've produced. So that's been put in there as a red herring for you. Okay, so 45,000 multiplied by the actual units of production of 31,900 gives us a total flexed budget cost of 1,435,500. Okay, so that's our flexed budget cost. If we then compare that to the actual cost, okay, so we're just going to write the actual cost there, and we compare the difference. If you take the actual figure away, you get a figure of 2,4,800. So that's the difference. Okay, so 2,4,800. Always start with your flex budget, okay, at the top, because this will help you to understand whether it's under or over. If your result comes out as a positive figure, okay, it means that your flex budget, as you can see there, is higher than your actual. So that means that you have over absorbed. So well done for those who have put that in into the answer. Okay. If it came out as a negative figure, so if your flex budget, as an example, was 1,310,700, this again, using this just for an example purpose, and your actual was 1,410,700, take that away, take the actual away, it comes to a negative 100,000, doesn't it? Okay, and the answer to that would have been under-absorbed by £100,000. Okay, so that's another way of working whether you've over or under-absorbed. Start with your flex budget, take off your actual. Does this answer come positive? If it does, that is how much you have over-absorbed by. If it's a negative answer, you've under-absorbed by that amount. Okay. Right, so any questions on that so far? No? So we have got 15 minutes left, but not to worry, because I do want to go through task 4. So those who do need to leave at 7:30, these sessions are recorded and you will get it within 24 hours. But I will stay on the session until we have finished task 4, okay, which is, it's absolutely fine with me. Okay, so all I would say is this can be tricky. If you understand how to do your variances, hence the reason I did them in full so you can get an understanding, you shouldn't have a problem with it. Okay, just get used to your own method of working out your variances, and it will make, you know, whether you use mine, whether you use what you've been using with your training provider, whichever way you do it, you just need to have that good understanding of how to work them out. Okay, so yes, we could have done that question a lot quicker by just doing that that part of the variance, but I wanted to give you full details of it. Okay, so task 4 is all about statistical information this time. Okay, so we're going to be looking at trends. We're going to be looking at different costs at different periods. You know, comparing what costs should be now to what they were when, you know, when we first did a project. Okay, so in this exam, it's going to take you about 19 minutes to do the task 4. Okay, so we've got loads of things coming there. You hate these questions, you know, unless you get yourself into a routine with how to answer them, then I understand why. But hopefully running through my method, I'm not saying obviously my method's the best, it's how I would answer these questions. Okay, so we're going to look at time series analysis. You're going to look at you might be looking at index numbers, using linear regression, and just remember, guys, this here is your linear regression calculation, your formula. You are going to need to know the formula. Okay, so just to give you the heads up why your linear regression, it's when we need to, this here is a semi-variable cost. So this shows you how to calculate. I put variances because we've been dealing variances last question. Variable costs. Okay, so A is your fixed cost, B is your variable element, okay, X is your output levels, okay, or the period that it adheres to, and then Y is your total cost. Yes, you do grow to love questions in accounts, especially when there's loads of nice formulas. Okay, you see them first of all, you think, oh my God, how am I going to deal with these? But yeah, you get yourself into a pattern and you do actually become a lover of them. So task 4. A business operates a standard costing system and uses raw material HJ3. The standard price was set on the market price of £200 per kilogram, when the market price index was 115.6. Okay, so when they purchased it at £200 per kilogram, the base index was 115. Now, just don't get confused, because sometimes people will just think base is just 100. It's not always 100. So just read the question. Okay. So if what's happened then within the period, the price index has increased to 112.536. The raw material has a price variance, which was £300,000 adverse. Okay. During the period, there was actual purchase of material of 15,000 kilograms. Yes, I always love maths as well. Okay, it's good learning new maths. Okay, learning how to do things anyway. So anyway, complete the statement below. In order to calculate your answers, you should split the raw material price variance into 2 components. Okay, by calculating the part of the variance explained by the change in the price index, and what can be not explained by the change in price index. Okay, so the first thing that we're going to look at then is we need to identify what the overall, what the cost would be overall for us to see how much can be explained in that in the change of cost. Okay, so part A then, the part of the variance explained by the increase is what? Okay, so what we need to do is first of all have a look from the data that we've been given what we should have spent. Okay, so if we have got 15,000 kilograms of material, and we're saying we should have spent £200 per kilogram, what we should have spent is £3 million. Okay, that is what we should have spent. However, the question has told us we have got a £300 adverse. So that is what we should have spent, but what we actually spent was £3,300,000. So you can see there the difference is that 300,000 adverse variance. Okay. So what we need to do is we need to budget. Well, how much per unit was it then? So if we spent £3.3 million, okay, and we bought 15,000 kilograms of material, okay, it's telling us that we've actually spent £220 per kilogram. Okay, that is what we actually spent. Okay, so up here is the budget. Down here is the actual. Okay, let's have a look at the price index. Okay, it is so much easier when you don't have all the zeros. Okay, so what we need to do is we need to work out what the cost would be based on that index price of 122,536. So how we do that is we take the original budget cost, the base cost, yeah, and we divide that by the base index. Once you have divided by the base index, you then multiply it by the current index, which is 122.536. And that will give you a total, which Elizabeth, well done for popping that in the question, and Denisa as well, I think you did that formula, and Jackie. It works out at £212 per kilogram. Okay, so that's what the index is saying it should have cost us. Okay, so if we have actually paid, let's have a think, 220, well, 212, so is what we've spent. There's a and 200, is what we originally budget. We can see that increase in £12, we can explain that. We know that the £12 increase from the 200 to the 220 is explainable. However, the 12 to the 20, which is the £8 per unit increase charge, that will be explained using different factors. Okay, so we'll just put it as an unexplained for the time being. Okay, so that £20 increase, 12 of it can be explained and 8 of it is not explained by that price index. So knowing we can explain 12, and in the question part B, it's to do with not explained, you just simply multiply that by the kilograms that we've purchased. So you got your 15,000 kilograms, and I'm going to write a pound symbol there, and then we've got 15,000 kilograms. So your answer there for so correct there in the chat is you've got £180,000 of that £300,000 variance, which is explainable by the price index. But then you've got £120,000, which is unexplainable by the price index. So this could be to do maybe with wastage or, you know, other factors that might incur when it comes to your material cost, okay? But as it stands at the moment, you just need to know what the costs are, okay? You go into detail more about this when you come to do those wordy questions, which we're going to cover one next week. Okay, so we now need to want to look at what the index is in change. It's, you know, we can clearly see here, yes, there's a £20 charge, okay. But what we need to really think about is it's not easy on the eye. Looking at 200 to compare to 20, looking at the index of 115 to 122, not that easy on the eye to look at from a manager's point of view. They want to see clear information, okay? So in terms of the percentage increase, all you would do is you will take the current price index and you would divide it by the base index, okay? And if you multiply that by 100, it should come out at 106. So what we can see there is there's been a 6% increase, okay? So just let's have a quick, why have we done the 300 and 300, not the price index straight away? It's just so you can work out, so we did it was Natalie, well done. So we worked out what the 300 were and the 330, just so you can compare the difference between the budget cost and actual. So there's been a £20 price increase. So when we look at when we look for what it was per kilogram, okay, which you could have done that if you want to. It's just to explain it a bit more. You can clearly see that £12 is explainable by using price indexing. Okay, so sorry, going back to this question here, there's an increase in 6%. Okay, so I hope everybody's okay with that one. What we're now going to do is we're going to move on to the next question. Okay, so I do know that somebody in the chat said you don't like this question. Okay, question D. So not to worry, we'll go through it step by step. So another business uses product WR12 and has collected data for the last few months in order to forecast the cost per kilogram, okay, of R12 in the next period. Okay. So we've got March, April and May, okay, and this is the cost per kilogram for each of those periods. It now says complete the table below to forecast the expected price of product in August and October. Okay. So first thing we need to do is we need to find an actual trend. We need to find what's going on. Now, again, looking at those three costs, it's not really easy on the eye to say, yeah, well, it's increased by this, it's increased by this. So what we have to do is we have to try and work out what the indexes are for each of those months. Now, we're going to use March as the base. Okay, so if we wrote here the index for each of those, we're going to say March has an index of 100. Okay, so to work out what the index would be for April, you take the current cost. So I'm just going to write this here. So that's 899.59. You divide it by the base cost, which is 85675, then you multiply it by the base of 100, and that should give you an index of 105. So we can see there's been a 5% increase each time. Okay. I wouldn't go up on using the 42.84 each time, because it might not do that as you get further up into your indexing. Okay, so we're now you've really got to, instead of looking at figures, you've got to look at the actual index numbers. So if we have a look at May, just so we can try and find again another trend. So you look at the current cost for May, which is 942.43, divide that by the base cost, of 856.75. Then you multiply that by 100, and this should give you an index of 110. So you can see each month that the index is increasing by 5. Okay, so this is 0, this is month 1, this is month 2. Okay, so if we write those months out in order, so we've got March, April, May, we've got June, July, August, September, October, because we need to find out August and October. So if March is our base month, then we've got 1, 2, 3, 4, 5, 6, 7. We know that August is our fifth year, or fifth period, sorry, and October is our 7th. Okay. Now all we need to do is we need to multiply each of the period numbers by the increase. So every month there is a 5%, there's a 5% increase. So 5 times 5 will give you that base, okay, of, so if I'm just going to write the index here, of 125. October, well done guys, you're really good at picking this up. 7 times 5, the index must be 135. Now you know what the indexes are for those 2 months. You can go back to using the indexes to work out what those costs would be. Okay, so just changing my colour pen over here. For August, you've got a base, a current index of 125. You're going to divide that by the base index of 100 and then multiply it by the base cost, which is 856.75. So that will give you an answer of 1070.94. Do the same for October. 135 divided by 100 multiplied by 856.75. That gives you a cost of 1156.61. Okay, so well done. So what I'm going to do is I'm just going to write something over here that might help you even more. Okay, this is if you need to find the price. Okay, you take the current index, so the current year index. So we want to find the current price, don't we? Sorry, apologies. You take the current index divided by your base index. So you can see, because you've got you've either got 2 costs or you've got 2 index numbers. Okay, so if you've got 2 index numbers, it means that you've got to find a cost. So 2 index numbers, your current divided by your base, multiplied by your base cost, that will give you the current price. So you can write that in initials if you want to. Always on your division, you have a base here, okay? And you always multiply by the base here, okay? That will then equal the current, as well as we've got the current up at the top. So whether you are dealing with index, you have an I or an I to get the cost, or whether you are trying to find what the index is, you should have a current cost divided by a current base, multiplied by your base index, and then that will give you your current index. So that's a table that made that method there that you might want to use to help you work out these questions. So if your base index is 100, could you just do the original base cost times the current index? No. Base current, could you just do your base cost? If your base is 100, could you just do the original base cost times the current index? So I don't get what you mean, Elizabeth, on that one. Sorry. Are you meaning 857 multiplied by the current index? So 857 by the 125. Well, you could do, because it will give you that if you want to. So there's an increase in 25. So 856.75 multiplied by 1.25. Yes, you could use that method because it is a 25% increase. So yeah, you can use that method if you wanted to. And again, work out the 35% increase, because that's what you're trying to do. Yeah, Phil, at the end of the day, you're not going to get examined on your workings, okay? Especially for this one, and this one you're not. But in your written questions, okay, you might be asked to explain how to work out the indexes, okay, to work through this method. Okay, so that's what you might do. Okay, right, the last part then of this question then, it says a colleague has calculated at least the least square regression line, which is the line of best fit if we think of the graph, as y. I'm just going to make it a bit clearer. Y equals 35 plus 75 multiplied by x. So we know 35 is the fixed cost. B is the variable cost. So in this question here, it says Y is the cost per kilogram, which we know X is the period, but July, okay, is period 36. Okay, so July X3 is period 36. And we need to work out what November is. So if July is 36, August must be 37. September must be 38, October must be 39, leaving November to be period 40. So we're going to redo that calculation. We're now going to 35 plus your 7.5 multiplied by 40, okay, which gives us a value of 300, okay. So Y must equal 335. Well done, everybody. 335. Good. And that is task 4. Okay. So in your exam, yes, you don't need to do your workings for this question. However, you're going to need to explain it and understand how you can see the difference in price index. So either use the method here, which works out the same, anyway. So the long formula. Natalie, is this the one that you're on about? Yes, that's fine. So yeah, this is a long formula which you're going to need to know to explain, where it says you've got to divide your current index by your base, or your current by your base, whatever you're dealing with, whether it's index or costing, to multiply by your base. This is something that comes in the written exam, okay? But I do like the fact that there is a quicker way of doing this, okay? So Natalie, is that everything done for you? Got that one? Yeah, oh, no, just write a bit more. Okay, so just while Natalia is finishing writing that up, we can clearly see, yes, we have worked out an increase in 35% from one for the year to the next. The idea of that one as well is to try and identify the trend. What's happening from one month to the next? We can see it go up in 5. We can see, it go up in 10, 12, whatever it goes up in. So when you've got the first month, if you multiply that trend by the relevant month, that will give you the price increase. So again, if you can then multiply by the 1.25 or 35 in this case. Okay, so hopefully that's given you an example of how to challenge task 3 and 4. Next week we'll be looking at task 5 and task 6. So task 5 is all about writing a report on the analysis, and then task 6 we're going to be looking at some performance indicators. So those who have done some of the other level 4 modules already, you would have seen these, but these are like the liquidity ratios, profitability ratios. So we'll be having a quick look at those next week as well. So thank you ever so much for this evening.